Imagine this scenario. You wake up on a Tuesday morning. You grab your coffee, looking forward to a quiet start to the day. You unlock your phone to check the weather, but a notification banner drops down, then another, then another. You open your brokerage app, and instead of the usual green and red mix, you see a sea of deep crimson everywhere. The news anchors on the TV in the background are shouting, their voices pitched high with urgency. They are talking about a market collapse, a black swan event. The stock tickers are plummeting right before your eyes. Your portfolio is down 20%. By lunch, it's down 30%. By the end of the week, half of your net worth, the money you saved for your house, your kids' education, your retirement, seems to have vanished into thin air. The headlines scream words like recession, depression, collapse, and the end of the economy as we know it. Your palms sweat, your stomach drops. A primal voice in the back of your head screams at you, sell everything, save what you can and run. It feels like the house is on fire, and your only instinct is to jump out the window. But what if I told you that while you see a burning house, the world's greatest investors, the Buffetts, the Lynches, the Dalios, see a for sale sign? Welcome back to MonsterInvest. I'm your host, Daniel. Today we are going deep. We aren't just scratching the surface of stock prices. We are dissecting the single most difficult, yet most rewarding challenge in the world of finance, investing during an economic crisis. Is it a reckless gamble that leads to ruin, or is it the calculated opportunity of a lifetime? By the end of this episode, you won't just have an answer, you will have a battle plan. Part 1: The Psychology of Fear. Before we talk about money, we have to talk about your brain. Why is investing during a crisis so hard? It's because biologically, we are wired to survive, not to trade stocks. There is a concept in behavioral economics called loss aversion. Psychologists have found that the pain of losing $1,000 is twice as powerful as the joy of gaining $1,000. When the market crashes, that pain center in your brain lights up like a Christmas tree. It triggers a fight-or-flight response. You also have to fight herd mentality. Humans are social creatures. If everyone is running toward the exit, our instinct is to follow them, assuming they know something we don't. But in investing, the herd is usually wrong at the extremes. This is why the average investor underperforms the market. They buy when everyone is celebrating at the top, and they sell when everyone is crying at the bottom. They let their lizard brain drive the car. But to be a successful investor, you have to fire the lizard brain. You have to understand that volatility is the price of admission for wealth. Part 2: A Tale of Two Crises. Let's look at history. History doesn't repeat itself exactly, but it often rhymes. I want to tell you two stories. One is a story of opportunity, and the other is a story of a trap. First, let's go back to 2008, the Great Recession. Meet an investor named Ben. Ben is an ordinary guy, but he follows the philosophy of value investing. In 2008, the world looked like it was ending. Lehman Brothers collapsed. Banks were failing. Unemployment was skyrocketing. Ben's portfolio was down 40%. Most of Ben's friends were panic selling. They said, cash is king, the system is broken, I'm getting out until things stabilize. But Ben asked himself a simple question: will people still brush their teeth in 5 years? Will people still buy soda? Will businesses still need computers? The answer was yes. The world wasn't ending, the financial gears were just jammed. Ben saw that solid companies like Coca-Cola, American Express, and Microsoft were trading for pennies on the dollar. Their stock prices were broken, but their businesses were not, so Ben did the unthinkable. He didn't sell, he used his emergency fund to buy more. He bought fear. 5 years later, the markets had not only recovered but hit all-time highs. Ben's friends who went to cash missed the recovery. They were still waiting for the right time to get back in, a time that never came. Ben, on the other hand, had built generational wealth. Now let's flip the coin. Let's talk about the risk part of our title, because not every drop is an opportunity. Let's travel back to the year 2000, the dot-com bubble. Meet Sarah. Sarah saw tech stocks dropping. She saw a company, let's call it Pets.com, that had fallen from $100 a share down to $10. She thought, wow, it's 90% off, it has to go back up. So Sarah bought heavily. She thought she was being like Ben. She thought she was buying the dip. But Sarah made a fatal mistake. She didn't check the business. The company was losing money on every sale. It had no path to profit. It wasn't a solid business on sale. It was a sinking ship. The stock didn't go back up. It went to zero. Sarah lost everything on that trade. This brings us to part 3, the noise machine. We have to talk about the media. In a crisis, the media is not your friend. Their business model is not to make you rich. It is to keep your eyes glued to the screen, and nothing sells advertising like fear. Market meltdown, billions wiped out. Is this the end? When you consume this content 24/7, it warps your reality. You start to believe that the temporary downturn is a permanent state of existence. You have to learn to disconnect, turn off the TV, Close the Twitter feed. Look at the numbers, not the narratives. Part 4, the strategy checklist. So how do we distinguish between a Ben scenario and a Sarah scenario? How do we navigate the noise? When the market crashes, you need a checklist. You cannot just blindly buy anything that is red. Rule number 1, the balance sheet test. In a crisis, cash is oxygen. Companies with heavy debt die. Companies with lots of cash survive. Before you buy a beaten-down stock, look at their debt. Can they survive a year with no revenue? If the answer is no, stay away. Rule number 2, the moat. Does the company have a competitive advantage? In 2020, during the pandemic, investors rushed to buy Amazon and Google. Why? Because even if the economy stopped, we needed them. We needed their services. That is a moat. Rule number 3, dollar cost averaging. You will never guess the bottom. Don't try. You aren't a wizard. Instead of throwing all your money in at once, buy a little bit every week or every month. If the market keeps dropping, great. You buy more at a cheaper price. If it goes up, great, your profit grows. This strategy removes the emotion. It creates discipline in chaos. Rule number 4, the 24-hour rule. This is my personal favorite. In a crisis, you will feel the urge to make a drastic move, to sell everything or buy something risky. When you feel that urge, wait 24 hours, do nothing, sleep on it. Usually the panic subsides and logic returns. Part 5, the waiting game. I need to be honest with you. This sounds easy on a podcast, but it is agonizing in real life. When you buy during a crisis, the market might not bounce back tomorrow. It might drop another 10%, then another 10. You will look foolish for months, maybe years. There is a famous saying, the market can remain irrational longer than you can remain solvent. This is why you must never invest money you need for rent or bills. Crisis investing is a long-term game. You are planting seeds in winter so you can harvest in summer, but you have to survive the winter first. Before we move to the summary, I have a small request. If you are finding value in this deep dive, if you want to become a smarter, more rational investor, please hit that like button and subscribe to the channel. It helps us huge amounts, and it ensures you don't miss our next breakdown. Join the MonsterInvest community, and let's grow our wealth together. Part 6, summary and key takeaways. We've covered a lot of ground today. Let's package this up into actionable wisdom. If you take anything away from this episode, let it be these 3 pillars. Number 1, crisis is the norm, not the exception. Recessions, crashes, and corrections happen. They are features of the system, not bugs. Don't be surprised when they happen, be prepared. Number 2, know what you own. Don't just buy a stock because the price is down. That is gambling. Buy a stock because the business is strong, the debt is low, and the product is essential. Avoid the value traps. Number 3, master your emotions. Your brain will scream sell at the bottom and buy at the top. You must fight this instinct. Create a plan now while things are calm so you can execute it when the storm hits. To conclude today's journey, I want to leave you with a thought. Wealth isn't made when the sun is shining and everyone is high-fiving on Wall Street. That is when wealth is merely displayed. Real wealth is created in the dark. It is created when the news is bad, when the outlook is grim, and when you have the courage to stand alone and say, I believe in the future. The next time the red arrows cover your screen, don't panic. Take a deep breath, check your list. And remember, this isn't the end. It's the beginning of your next chapter. This has been Daniel with MonsterInvest. Thank you for listening. Stay rational, stay hungry, and I'll see you in the next episode.